Ladies and gentlemen, listen to me very carefully, because moments like this don't knock twice. When power feels threatened, it doesn't whisper, it moves fast. Today's title is not just a headline, it's a warning bell. Emergency. CFTC. Meeting Thursday 9 a.m. Now ask yourself, why the rush? Why the urgency? Why now? Whenever ordinary people are told not to look, that is exactly where you must focus your attention. History teaches one brutal lesson. When financial systems crack, the rules change overnight. Markets that were free on Monday become regulated by Friday doctrine. And the CFTC, an institution meant to oversee fair markets, suddenly calling an emergency meeting should make every serious investor sit upright. This is not about silver alone. This is about control. Control over price discovery, control over demand, control over what the public is allowed to protect itself with. An unscheduled or emergency meeting by a major regulatory body is never a routine administrative event. It is a signal that normal market mechanisms are under strain. In stable financial environments, regulators follow structured calendars, public consultation periods, and gradual implementation of policy changes. When that process is suddenly bypassed, it suggests that developments are moving faster than the system's ability to manage them quietly. This is why markets pay close attention, not just to the outcome of such meetings, but to the urgency itself. Urgency is information. It tells you that something has already broken beneath the surface, even if the official narrative has not yet caught up. The Commodity Futures Trading Commission exists to ensure market integrity, transparency, and fair price discovery. Its mandate is not to eliminate volatility, but to ensure that volatility reflects real supply and demand. When an emergency meeting is called, it raises an uncomfortable but necessary question. Is the regulator responding to genuine systemic risk, or is it responding to pressure from institutions that are exposed to that risk? History shows that regulators often act fastest, not when consumers are harmed, but when leverage, derivatives exposure, or counterparty risk begins to threaten larger financial actors. That distinction matters because it reshapes how markets interpret regulatory intent. Here is where the hook becomes unavoidable. Markets do not panic because of bad news, they panic because of unexpected news. An emergency meeting is, by definition, unexpected. It introduces uncertainty into a system that already operates on confidence. Investors immediately begin to model scenarios, position limits, trading halts, increased margin requirements or restrictions on participation. Even before any rule is announced, behavior changes. Liquidity tightens, spreads widen, and risk premiums rise. In other words, the meeting itself becomes a market-moving event, regardless of what is ultimately decided. Another critical dimension is timing. Emergency regulatory actions almost always occur after pressure has built for an extended period. They are rarely proactive. They are reactive. By the time regulators convene on short notice, price movements, speculative positioning, or physical supply stress have already reached levels that can no longer be managed through routine oversight. This means that the public is often seeing the final act of a much longer process. The question sophisticated observers ask is not what are they about to do, but what forced them to act now. There is also a structural reality that cannot be ignored. Modern financial markets are deeply interconnected through derivatives, leverage, and algorithmic trading. A disturbance in one market can cascade rapidly into others. Regulators are acutely aware of this fragility. An emergency meeting suggests concern that a localized issue could become systemic if left unchecked. However, systemic risk does not arise from retail participation alone. It arises from concentrated exposure and excessive leverage. When regulatory urgency appears, it often points to stress within the financial architecture itself, rather than irrational behavior by individual market participants. The most revealing hook lies in what is not immediately disclosed. Emergency meetings are frequently accompanied by vague language, monitoring conditions, ensuring orderly markets, maintaining stability. These phrases sound reassuring, but they are also deliberately broad. They allow regulators flexibility while limiting public scrutiny. For experienced market participants, this lack of specificity is not calming. It is cautionary. It implies that multiple intervention tools are being considered and that outcomes are not yet fully contained. Finally, such meetings redefine risk perception. Once regulators signal urgency, the assumption of a neutral playing field weakens. Market participants begin to factor political, institutional, and regulatory risk alongside economic fundamentals. That shift alone can alter capital flows, even in the absence of formal policy changes. In this sense, an emergency regulatory meeting is not just a response to market stress, it becomes a catalyst that reshapes behavior, expectations, and strategy. Those who understand this do not wait for headlines to confirm reality. They read the signal embedded in the urgency itself. Silver occupies a unique position in the global economic system because it operates simultaneously as an industrial input and as a monetary asset. This dual nature makes shifts in silver demand particularly revealing. When interest in silver accelerates beyond normal industrial cycles, it often signals something deeper than supply chain dynamics. It reflects changing expectations about inflation, currency stability, and the long-term purchasing power of money. In economics, expectations drive behavior, and silver demand has historically been a quiet but reliable indicator of when confidence in fiat systems begins to weaken. Unlike paper currencies, silver cannot be created at will. Its supply grows slowly, constrained by geology, mining investment, and energy costs. When central banks expand balance sheets and governments increase fiscal deficits, the contrast becomes impossible to ignore. Investors do not move toward silver because it promises explosive growth. They move toward it because it preserves value when monetary discipline erodes. Here's the first hook that matters. People do not rush into metals when they are optimistic about the future of paper money. They do so when they are preparing for its decline. Inflation is not just a rise in prices. It is a decline in purchasing power. When households and institutions begin to sense that currency units buy less over time, they look for assets that cannot be diluted. Silver, with its long monetary history, becomes a natural candidate. This behavior often appears before inflation is officially acknowledged in data. Economic reports are backward-looking, but market behavior is forward-looking. A sustained increase in silver demand suggests that participants are pricing in inflation that has not yet fully appeared in consumer price indices. Another powerful signal lies in trust. Modern fiat systems are built entirely on confidence in central banks, in government debt, and in the stability of financial institutions. When that trust weakens, even subtly, capital seeks alternatives. Silver does not rely on a promise or a policy framework. It relies on physical scarcity and universal recognition. This is why periods of aggressive monetary easing or prolonged negative real interest rates often coincide with renewed interest in precious metals. The hook here is uncomfortable but necessary. When savers earn less than inflation, saving in currency becomes a guaranteed loss. Silver also reflects concern about currency debasement. Debasement does not require hyperinflation. It occurs gradually through persistent deficits, debt monetization, and policy choices that favor short-term stability over long-term value. As currencies are weakened to manage debt burdens, hard assets gain relative strength. Silver's affordability compared to gold makes it especially attractive during these phases, broadening participation and amplifying demand. That widening demand base is not speculative mania. It is collective recognition that monetary policy has consequences. There is also a global dimension that is often underestimated. Silver demand rises, not only in developed economies, but also in regions where currency volatility is a lived experience rather than a theoretical risk. In such environments, silver functions as informal savings, a hedge against policy error, and a bridge between formal and informal economies. When global demand aligns across diverse regions, it suggests a shared concern about the trajectory of fiat currencies rather than isolated local issues. Perhaps the most revealing hook is this. Silver demand tends to increase when faith in policy narratives declines. When official messaging insists that inflation is temporary, debt is manageable, and stability is assured. Yet behavior in metal markets tells a different story. The divergence is meaningful. Markets are not emotional, they are adaptive. Silver does not speak through press conferences or policy statements. It speaks through demand. And when that demand rises persistently, it is not predicting collapse, it is signaling caution. In economics, caution signals matter long before outcomes are visible. And silver has a long record of signaling stress well before it becomes headline news. Market intervention becomes most visible when the distinction between free markets and managed outcomes begins to blur. In theory, free markets function through voluntary exchange, transparent pricing, and the continuous interaction of supply and demand. Prices rise when demand exceeds supply and fall when the opposite occurs. This mechanism is not a flaw. It is the core signal that allows capital, labor, and resources to move efficiently. When authorities intervene to restrict buying rather than address underlying imbalances, they are not correcting the signal, they are muting it. And muted signals do not eliminate risk. They redistribute it, often to those least prepared for sudden change. Intervention aimed at controlling demand usually emerges when price movements threaten existing structures. Rapid price appreciation exposes leverage, mispricing, and structural weaknesses that were manageable under stable conditions. Instead of allowing prices to adjust naturally, regulators may introduce limits, restrictions, or temporary bans under the justification of maintaining orderly markets. Here's the first critical hook. Markets are only called disorderly when outcomes become uncomfortable for those with concentrated exposure. Volatility itself is not evidence of failure. It is evidence of information being processed in real time. Free markets are designed to reveal scarcity. When demand rises sharply, it sends a message that supply is insufficient at current prices. Intervention that suppresses demand interrupts this message. The result is not stability, but distortion. Artificially constrained demand leads to false pricing, delayed adjustments, and pent-up pressure that eventually resurfaces with greater intensity. History repeatedly shows that price controls and participation limits do not remove market forces. They simply push them into less transparent channels, where risk becomes harder to measure and manage. Another hook lies in the asymmetry of intervention. Restrictions are rarely applied evenly across all participants. Institutional actors often retain access through exemptions, alternative instruments, or off-market mechanisms, while retail and smaller participants face direct limitations. This creates a two-tier market that undermines the principle of equal access. From the economic standpoint, such asymmetry damages confidence more than volatility ever could. When participants believe the rules can change selectively, risk premiums increase, capital becomes defensive, and long-term investment behavior shifts. Intervention also alters incentives in subtle but powerful ways. If market participants expect that price rises will be capped through regulatory action, they may reduce productive investment, knowing that returns are politically constrained. At the same time, suppressed prices can encourage overconsumption or misallocation of resources. The irony is that interventions designed to stabilize markets often weaken them by discouraging the very behaviors, investment, transparency, and risk-taking that sustain healthy price discovery. There is a deeper issue beneath demand control: accountability. Addressing underlying imbalances requires confronting difficult realities such as excessive leverage, structural deficits, or policy-driven distortions. Restricting buying is faster and more visible, but it avoids these root causes. The hook here is subtle but decisive. When policy chooses speed over substance, it signals that the system lacks the flexibility to absorb honest pricing. That signal is noticed, not just by speculators, but by long-term capital allocators. From a macroeconomic perspective, persistent intervention reshapes expectations. Markets begin to operate not on fundamentals alone, but on anticipation of regulatory reaction. This feedback loop reduces efficiency and increases uncertainty. Participants are no longer asking, what is this asset worth? But what will regulators allow it to be worth? Once that shift occurs, markets become less about value discovery and more about policy navigation. Perhaps the most revealing hook is this: truly free markets can tolerate transparency, even when outcomes are uncomfortable. Intervention that targets demand rather than causes suggests a reluctance to accept those outcomes. It reflects an environment where stability is defined not by resilience, but by control. And while control may delay visible stress, it rarely eliminates it. Instead, it accumulates pressure quietly, until the gap between reality and regulation becomes too wide to manage discreetly. Sudden regulatory changes rarely land evenly across the market, and retail investors tend to feel the impact first and most directly. Unlike large institutions, retail participants do not have compliance teams, alternative trading channels, or the ability to restructure exposure overnight. Their access is straightforward and visible, which makes it easier to restrict. When new rules are introduced with little notice, retail investors are forced to react within narrow time frames, often under uncertainty and emotional pressure. That imbalance is not accidental. It is a structural feature of how modern markets respond to stress. Here is the first hook that deserves attention. Retail investors are often encouraged to participate in markets during periods of stability, but are constrained precisely when participation becomes most meaningful. When markets are calm, access is wide and risk appears manageable. When volatility rises and protective assets become attractive, access suddenly narrows. From an economic perspective, this creates a one-sided exposure, where retail investors bear downside risk but face barriers when attempting to hedge against systemic threats. Retail investors also experience information asymmetry in these moments. Regulatory announcements are frequently framed in technical language, released during market hours, and interpreted in real time by professionals who have faster access to analysis and execution. By the time retail participants understand the implications, prices may have already adjusted. This delay transforms policy changes into de facto wealth transfers, not through explicit taxation, but through timing and access. The hook is uncomfortable but real. Markets do not need to be rigged to feel unfair. They only need unequal reaction speeds. Another layer of impact lies in forced decision-making. When rules change suddenly, retail investors are pushed into binary choices: buy now or miss the opportunity, sell now or risk being trapped. This environment amplifies behavioral biases such as panic, herd behavior, and regret aversion. Economically rational decision-making becomes difficult when the rules of engagement are shifting mid-game. The result is often suboptimal outcomes that are later framed as individual mistakes rather than systemic design flaws. Retail investors are also more likely to rely on traditional hedges to protect purchasing power, especially in inflationary environments. When access to those hedges is restricted, their portfolio resilience weakens. Institutions can offset restrictions through derivatives, foreign markets, or private transactions. Retail investors cannot. This creates a widening gap in risk management capability. The hook here is subtle but powerful. Restrictions do not eliminate risk. They concentrate it where it is least manageable. There is also a long-term trust implication. Markets function efficiently only when participants believe the rules are stable and consistently applied. Sudden interventions erode that belief, particularly among smaller participants who already perceive the system as tilted against them. When trust declines, retail investors either withdraw from markets entirely or engage in more speculative behavior to compensate for perceived disadvantages. Both outcomes reduce market quality. Participation falls, liquidity thins, and volatility increases over time, even if short-term stability appears restored. The psychological impact should not be underestimated. Retail investors often view market participation as a path to financial security, independence, or protection against macroeconomic uncertainty. When regulatory actions restrict that path without warning, it reinforces a sense of exclusion. This is not merely emotional. It has economic consequences. Reduced confidence leads to lower savings participation, misallocation of capital, and greater reliance on consumption over long-term planning. The hook here is direct. A system that undermines confidence in lawful participation weakens its own foundation. Finally, repeated exposure to sudden rule changes conditions retail investors to expect intervention rather than fairness. Over time, expectations shift from value-based investing to rule avoidance strategies. Instead of analyzing fundamentals, participants focus on anticipating regulatory moves. This degrades market literacy and distorts incentives. Retail investors are no longer rewarded for patience or discipline, but penalized for not anticipating policy shifts. In economic terms, the disproportionate impact on retail investors is not collateral damage. It is a measurable outcome of how intervention operates in practice. When access is constrained, timing is compressed, and alternatives are unavailable, retail participants absorb uncertainty that larger actors can sidestep. And when that pattern repeats, it reshapes not just portfolios, but the relationship between the public and the market itself. Liquidity is the lifeblood of any functional market. It allows participants to enter and exit positions efficiently, ensures narrow bid-ask spreads, and supports reliable price discovery. When buying is artificially limited through regulatory measures, liquidity does not disappear evenly. It fractures. Some participants withdraw entirely, others reduce position size, and a few retain access through alternative or exempt channels. The immediate appearance may be calmer price action, but beneath that surface, the market becomes thinner and more fragile. The first hook is simple but critical. Quiet markets are not always healthy markets. Artificial limits on buying disrupt the natural flow of orders. In a free market, liquidity emerges from diverse participation, buyers and sellers with different time horizons and motivations. Restrictions remove entire categories of demand, creating gaps where prices should be continuously formed. These gaps increase execution risk and reduce confidence in quoted prices. When participants are unsure whether they can transact at fair levels, they demand higher risk premiums or avoid the market altogether. This behavior further reduces liquidity, creating a feedback loop that weakens the market's ability to absorb shocks. Price suppression is often presented as a temporary stabilizing measure, but its long-term effects are rarely neutral. When prices are prevented from reflecting true demand, signals to producers, investors, and consumers become distorted. In commodity markets, suppressed prices discourage investment in supply. Capital-intensive industries rely on price signals to justify long-term projects. If prices are capped or artificially restrained future supply contracts, the hook here is unavoidable. Suppressing prices today often guarantees higher volatility tomorrow. Another dimension of liquidity risk emerges in the structure of derivatives and leverage. Many market participants hold positions not in physical assets but in futures, options, and other synthetic instruments. These instruments depend on continuous liquidity to function properly. When buying restrictions reduce participation, margin requirements can rise, spreads can widen, and forced liquidations can occur. What begins as a targeted intervention can quickly propagate through interconnected markets. The hook is revealing. Interventions designed to reduce volatility can amplify it once liquidity is stressed. Artificial limits also encourage the growth of off-exchange or opaque trading venues. When participants are restricted in regulated markets, they seek alternatives where rules are less visible or enforcement is weaker. This migration reduces transparency and makes aggregate risk harder to monitor. From a regulatory standpoint, this outcome is counterproductive. Instead of containing risk, intervention disperses it into areas where oversight is limited. The appearance of control increases, while actual control diminishes. There is also a psychological component that affects liquidity behavior. When participants observe repeated interventions, they adjust expectations. Rather than providing liquidity during periods of stress, they withhold it, anticipating that rules may change again. This behavior reduces the pool of natural stabilizers in the market. In economic terms, liquidity becomes procyclical. It disappears when it is needed most. The hook is subtle but powerful. Markets lose resilience not from volatility itself, but from the expectation of interference. Long-term volatility is shaped by how pressure is released. In free markets, adjustments occur continuously through price movements. When pressure is suppressed, it accumulates. Eventually, that accumulated pressure finds an outlet, often through abrupt repricing or disorderly moves. These events are more damaging than gradual adjustments because they occur when participants are least prepared. Artificial stability creates complacency, which magnifies shock when reality reasserts itself. Perhaps the most important hook lies in credibility. Markets operate on trust. Trust that prices mean something, that liquidity will be there when needed, and that rules will not arbitrarily override fundamentals. When buying limits distort liquidity and suppress prices, that trust erodes. Participants begin to question whether prices reflect reality or policy. Once credibility is weakened, restoring it becomes far more difficult than maintaining it in the first place. In economic terms, liquidity and volatility are not opposites. They are connected through confidence. Artificial constraints on buying may dampen visible price movements in the short term, but they undermine the structural conditions that allow markets to function efficiently over time. The risk is not that volatility disappears, but that it returns suddenly. That it returns suddenly, concentrated, and amplified by the very measures intended to prevent it. Periods of regulatory uncertainty place a premium on timing, preparation, and disciplined strategy rather than reactive behavior. When rules are stable, markets reward analysis of fundamentals and long-term positioning. When uncertainty enters the system, those same markets begin to reward flexibility and foresight. The first hook to recognize is that uncertainty itself is a form of information. It signals that existing frameworks are being questioned and that the range of possible outcomes has widened. Participants who ignore this signal often find themselves reacting after options have narrowed. Preparedness in such environments does not mean predicting specific regulatory actions. It means structuring exposure so that no single decision or announcement can create disproportionate damage. Economically sound risk management focuses on diversification, liquidity awareness, and position sizing that reflects not just market volatility, but policy risk. When participants overcommit in anticipation of favorable outcomes, they increase vulnerability to sudden rule changes. Strategic positioning, by contrast, assumes that not all variables are controllable, and builds resilience accordingly. Another critical hook lies in the difference between reaction and response. Reaction is immediate, emotional, and often driven by headlines. Response is measured, informed, and aligned with predefined objectives. In regulatory transitions, headlines tend to arrive faster than clarity. Those who react impulsively often transact at unfavorable prices, while those who respond according to a prepared framework preserve optionality. Optionality, the ability to act later without penalty, is one of the most undervalued assets in uncertain environments. Timing also matters in how information is processed. Regulatory shifts are rarely binary events, they unfold in stages. Initial signals are often ambiguous, followed by clarification and then implementation. Market pricing tends to adjust ahead of formal action, particularly among informed participants. This creates a gap between perception and reality. The hook here is decisive. Waiting for certainty often means accepting worse terms. Markets reward those who act when probabilities shift, not when outcomes are finalized. Preparedness also extends to understanding market structure. In periods of stress, liquidity can evaporate quickly, spreads can widen, and execution risk increases. Strategic participants anticipate these changes and avoid placing themselves in positions that require immediate exit under adverse conditions. They prioritize instruments and structures that allow flexibility, even if those choices appear less efficient during calm periods. The trade-off between efficiency and resilience becomes visible only when uncertainty arrives. There is a behavioral dimension that cannot be ignored. Regulatory uncertainty heightens emotional responses: fear of missing out, fear of loss, and fear of being trapped. These emotions distort decision-making and lead to herd behavior. Prepared participants counteract this by relying on predefined rules rather than real-time sentiment. The hook here is subtle but powerful. Discipline is not restrictive. It is liberating. It reduces cognitive load and prevents emotion from overriding strategy. Another aspect of preparedness is scenario analysis. Rather than anchoring to a single expected outcome, strategic participants evaluate a range of plausible scenarios and their implications. This approach does not require precise forecasts. It requires understanding sensitivity, which positions benefit from restriction, which suffer, which are neutral. By asking these questions in advance, participants reduce surprise and improve adaptability. In economics, resilience is not about avoiding shocks, but about absorbing them without structural damage. Perhaps the most compelling hook is this: the greatest cost of regulatory uncertainty is not short-term volatility, but long-term complacency. Those who repeatedly rely on last-minute reactions train themselves to operate in crisis mode. Over time, this erodes capital, confidence, and strategic clarity. Preparedness, by contrast, compounds. Each disciplined decision strengthens the framework for the next period of uncertainty. In environments where rules can change quickly, the advantage shifts from those with the fastest reactions to those with the strongest preparation. Strategic timing is not about guessing the next announcement. It is about being positioned so that no announcement forces a decision under pressure. That difference separates participants who survive uncertainty from those who are shaped by it. So I'll leave you with this: history does not remember excuses, it remembers preparation. If the next 72 hours matter, then clarity matters even more. Stay calm, stay informed, stay ahead. Because when the dust settles, the people who win are not the loudest. They are the ones who saw the storm forming, while others were still debating the weather. Thank you, and stay awake.